Today we're diving into the most popular income ETF on the Australian Stock Exchange, but the question is it the best? Welcome to ETF Explained, a series on the Get Started Investing podcast. In these episodes, we explore one ETF to better understand it and help you analyze your ETFs. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode today. We are talking about the Vanguard Australian Shares High Yield ETF. The ticker is VHY, and as you said, it is the most popular Australian income ETF, or the income-focused ETF in Australia. And so we're going to break it down. We're going to unpack what's under the hood, how much does it cost to access, how much income is it paying, how much growth has it got, how it achieves all of that. But really the key question we want to answer by the end of this episode, is it actually the best way to get income through Aussie ETFs?
Yes, the VH, why should I be investing in this? So let's start, as always, with the name, because there's a lot of information that you can get out of the name of the ETF. So let's start. Vanguard is the product issuer. Then we get to Australian shares, which is an indication of the underlying securities that you're going to be investing in the Australian stock market. And then high yield, which is really an indicator of the strategy for this ETF, meaning that the ETF is focused on investing with the outcome of providing income supposedly above a traditional asset, an index.
Supposedly. Okay, here we go. So look, whenever you're analyzing an ETF, the place to go is the ETF issuer's website. By law and by regulation, they have to disclose a heap of information on their website. So it's a really useful source of information to understand what's going on under the hood. If we jump on to Vanguard's website, we see that the purpose of the ETF, in their own words, is to provide low-cost exposure to companies listed on the Australian Securities Exchange that, and this is the important bit, have a higher forecast dividend relative to other ASX-listed companies.
Yeah.
So that's what Vanguard are doing. They're taking the Aussie market and they're screening out some companies with lower forecast dividends, and so you're left with the basket of stocks that should be paying higher than average. So what benchmark or index does it track to give us this?
So it tracks the FTSE Australian High Dividend Yield Index, which interestingly Vanguard actually has exclusive rights to, so you're not going to find it with any other provider. And they screen, as you said, for high dividend payers and sustainable dividends, avoiding those dividend traps, or those companies that might look like they're paying good dividends, but it's just because they've had poor performance when it comes to share price.
Yeah. So fees to access this, Vanguard said it's low cost exposure. The fees are 25 basis points. I think that counts as low cost exposure.
Absolutely.
It's funny, your perception gets warped with some of the crazy low costs out there, but 25 basis points is cheap. Now, the big question, how has it actually gone in terms of paying income? So it pays income quarterly.
Love that.
But over the past 12 months, what's been its annual yield?
4.9% is what it's paid over the last 12 months.
Okay.
Yeah.
So I guess the question becomes 4.9%. What has the ASX 200's dividend yield been over the past year?
About the same.
4.5%.
What's my high interest savings account been?
It would start with a 5.
Yeah,
sure.
5.5.
So I think there's some threads here that we're going to unpack for the rest of this episode. But I think that's what you've got to put it in context. So Vanguard say they screen out the lower paying stocks in large cap Aussie world, and they give you companies that are paying higher dividends. But really, when you look at the ETF over the last 12 months, it's paid 4.9%. And just a standard ASX 200 ETF has paid 4.5%. So they're not wrong, but perhaps the difference isn't as high as you would think.
Yeah. Now we're going to dig into the top holdings and the reasons why in a moment, but we should just look at total returns. And this includes the dividend payments. So when you're looking at these numbers, don't think that you're getting income in these percentages. This includes capital growth or appreciation of the underlying stocks, plus that sort of 4.5% that we've just spoken about. So over the last 12 months, it's done just shy of 20%, which is in line with the return of the ASX 200. Over the last 3 years, it's done about 11.5% per year. For the last 5 years, it's just shy of 10% per year. And since inception in May 2011, it's done just over 9% per year with dividends reinvested.
Now, I just want to be clear that you've said it's about in line with the Australian market. It is actually below the Australian market. So you said the total return of VHY is similar to the total return of the overall Aussie share market.
Mm-hmm.
In the past 12 months, the total return of VHY is 21.26% to be exact. Of VAS, the Vanguard ASX 300 ETF, 24.82%. So it has actually underperformed the overall Aussie market in the past 12 months. Since inception, though, you're right. It is almost bang on the same. Since inception, VHY 9.16%. Since inception for VAS, 9.22%.
Yeah. Now, let's jump into the top holdings. Again, very important you understand what you're buying when you're buying ETFs, and you can find all of this information on the website. So VHY has 65 holdings in total. It is really the who's who of the Australian blue chips. But most importantly, the top 10 make up 65% of the total portfolio. So that's where you're going to get the most income and the most return driving this ETF. A few other things around the construction. So the percentage invested in any one industry is restricted to 40% of the ETF and 10% of any one company. And they also exclude REITs or real estate investment trusts from this ETF as well.
Okay, so let's look at the top holdings. Tell me if you think this sounds familiar. Commonwealth Bank, BHP, NAB, Westpac, ANZ, Macquarie Group, Rio Tinto, Woodside, Telstra, Transurban.
ASX top 10.
Sound familiar? What are the names that are missing from there, from that actual ASX 200 top 10?
Retail.
No, yes, but CSL,
Telecom,
and Goodman Group are the ones that stand out for me. Goodman Group missing. Goodman Group has been the biggest growth story of the past 12 months in Aussie large caps. You know, it's been a real winner from the AI trend. And the fact that it's missing from VHY and is in VAS is probably a big reason why VHY has underperformed VAS.
Yeah.
CSL as well hasn't done as well over the past 12 months. Hasn't done well, full stop. But it's obviously like a lot growthier name than some of the big banks and the like. So that's what you screen out if you really want to focus on higher than average income payers.
Yes. BHP, Fortescue is not in there. No. Woodside, they've also had negative past 12 months as well, really dragging it down, and BHP makes up almost 10% of the portfolio. But the reason they're in there is because they pay dividends sustainably.
Yeah, of course. Yeah. It may be the most popular, but that isn't the most important question. And this one came through from Sue.
Hi. Bed and Rent, is VHY on ASX the highest dividend yield ETF?
All right, Bryce. Well, that is the question. That is really what you're investing in an ETF like this for. It's for the income. So is it the best income that we can get on the ASX?
Short answer is no.
Great, done.
Yeah. Short answer is no. Look, I think you can start with the comparison we made earlier. First off, we'll use the comparison to the ASX 200, and it is in line. So there are products out there that are designed to give a greater yield than VHY. The part of Sue's question is how can you work it out? We'll put a link in the show notes to a list of all of the ETFs based on dividend yield. There is a better one for Australian listed companies, and it's actually BetaShares Australian Dividend Harvester.
What does that pay?
Not a lot more, but it is a little bit better. It's in the fives at the moment.
Okay.
But still not crazy in terms of percentage more than you would get by just investing in the ASX 200.
Yeah. It also has 3 times the management costs.
Yes, more expensive. I think the 12-month distribution yield is just under 6%.
Okay.
So slightly better. But that is the only real comparison when you're looking at ASX listed ASX shares income ETFs.
Yeah. So look, I think to close this episode out, we should just say, because there are so many different structures of ETFs, like so many different ways that you can invest through ETFs, there are better income opportunities out there. We kind of can classify them in sort of 3 buckets. So there's the high yield index ETF, that is what we've spoken about today. Vanguard have one, you mentioned the BetaShares one, and they pay maybe slightly above the normal stock market index. Then there are active ETFs that will take a more active approach, but often would use more complex financial instruments like derivatives and options to increase their yield. One that we've spoken about on the podcast before is JEPI, the JP Morgan ETF. Its 12-month yield is about 6.5%. BetaShares also have one, YMAX, that has a 12-month yield of 7.5%, 7.6%. So that's the second bucket, those like active and complex products that are a little higher fee, a little more risk, but potentially have higher income. And then the final bucket that often gets forgotten when we're talking about income is just bond ETFs. Bonds are designed to be income-paying investments, and you can access bonds through ETFs, and you can, depending on where you want to sit on the risk curve, you can invest anywhere from a government bond ETF that might pay 1 or 2% a year, and you can go up the risk curve and you can get 5, 6, 7% if you want. So there are options, is I guess what I'm saying. And to answer Sue's question directly, the Vanguard high yield is certainly not the highest option.
It's not the highest. It seems like a mid-range, really.
Yeah.
There are plenty of mid-range. And I think importantly, if you are doing research online and you are looking at ETFs and the information around the yield that it's been producing over the past 12 months, make sure you understand how that yield has come about, because some of the ETFs that are out there, it could be a one-off instance. It could be something that it's not designed to produce yield. And so I think you just need to be careful of, are you actually investing in products purposely set up for income, or is it just a result of what's going on in markets?
Yeah. So to put a bow on the VHY conversation, it's a perfectly fine ETF. I wouldn't be worried if you're investing in it, but you should just go in eyes wide open that you're essentially investing in the Aussie large caps with a different name on the tin.
Pretty much.
Do you think that's fair?
Well, considering that 65% of this is essentially almost the top 10 ASX 200, and about 50% of the returns of the ASX 200 come from these. Yes, you're effectively getting
banks and miners,
99% correlation to the ASX 200.
Yeah. And so if that's what you want, and that's great, but I'm just going to invest in the ASX 200.
Yes. Well, we love hearing from you. So if you have an ETF that you want us to cover, please, if you're watching on YouTube, mention it in the comments below. If you're listening to us on the podcast, send us an email at equitymates.com/contact, and we'll make sure that we cover it on the show. If you love these episodes, also let us know. If you can leave a review wherever you're listening, we really appreciate it. It goes a very long way to helping us get in front of new Equity Mates audience. But that does it for now, Ren. We'll pick it up next week.
Sounds good.